We good to go there? You seeing it again, Jason?
We got it.
Good. Awesome. Well, it's a pleasure to be here tonight. I'm excited to visit with you all about LRP and different risk management strategies that you should be talking to your producers about. You know, cattle prices are great right now. It's good to be in the beef business. And I like to tell folks when it comes to LRP, you really can't afford not to, especially when prices are this good. A lot of folks are always like, well, it's that good. Why do I need to insure these animals? And as all of you know, if you've been in the livestock business, the amount of market volatility that we are exposed to on a daily basis is unreal. And right now, we're still seeing historically high prices, specifically in the beef industry, fairly low commodity prices in terms of your grains. But still, despite all the market fundamentals being in our favor, the volatility of those markets is still very real. And sometimes those markets will take a significant dip for no reason when those market fundamentals don't change. And that's why I try to tell folks, regardless of how good or bad prices are, with as easy as the LRP product is to use and cater it to your producers, it's really a no-brainer. But before we get into the nuts and bolts of it, I do want to introduce you guys, me and my business. ICAP Crop Insurance has been in the insurance business since 1990. It was actually an agency that was started by my mother. She's the other agent here in the office, and we exclusively focus on crop insurance, pasture, hay, and livestock. So the agricultural commodities is really our niche and what we live and breathe every day. But what I also think makes us unique is that, we're no different than the customers that we serve. We're also farmers. We've got day jobs, but, we make our living in the agricultural industry, specifically with livestock. So I don't like to recommend products that I haven't or wouldn't use myself. So in general, as far as different livestock and risk management strategies that producers can implement, there's 4 major products that they can use. There's the dairy revenue protection for your dairy producers, LRP protection, pasture range and forage, and then also livestock gross margin. The livestock gross margin, in theory, can be a good product. They're still tweaking on that program. It doesn't matter what kind of business you are, whether you're dairy, cattle, swine, diversified crop operation. That's a kind of product that's based on your inputs and overall farm revenue. But tonight we are just going to focus on that livestock revenue protection mostly. And if at the end, if anyone has questions, I'd also be willing to visit with you guys about the PRF coverage, which is a great complement to LRP. Livestock revenue protection insures only against declining market prices. The coverage price is selected by the producer. There is lots of flexibility with this product, and especially here in the later slide, you'll see how much it can be catered to each individual operation. Like I said, it only provides a single peril price, a risk protection. So it does not protect against any other risk except for decline in price. So mortality, disease, those kinds of things aren't covered under this policy. I do want to note that cattle that are covered under an LRP policy, if they die during the insurance period, as long as you provide timely notice of that loss, which is within 72 hours of when your producer finds that they've lost a covered animal, as long as they notify their agent will then notify your AIP or your approved insurance provider, and they'll make a note on your policy. Then come at the end of the insurance period, if you do have a loss, you have to provide some sort of proof of ownership. And assuming that the producer provided timely notification of that loss. If they are due a payment, they will still get paid for that animal that passed. But if they don't have a loss, they still have to pay the premium on that animal. So that's why it's not really a mortality policy, but you could potentially still get paid on those animals that don't make it to the end of the insurance period. These products, it doesn't matter how big or small your operation is, it can really be tailored to fit you and what works best. It works great when you're a large producer, but I could argue that it almost might be more convenient for your smaller producers and keeps them more competitive within the market and being able to capitalize on some of those prices that only larger producers usually see. It just like crop insurance, it is a subsidized program. So depending upon your level of coverage that you select, you are eligible for varying levels of government subsidy. The easiest way I know how to describe LRP to folks, if you're familiar with different marketing aspects that you can take advantage of, such as contracts, hedges, options, so on and so forth. LRP is essentially a subsidized put. You are putting a floor on those animals, and the government's going to help pay for part of that premium. One thing that I also think is really nice to point out that some people traditionally really don't think about is that this form of risk management can sometimes tend to be more accepted by lenders versus your traditional futures or options contracts. When you've got a lot of these guys that are going to the bank to try to, take out an operating loan to, buy groups of livestock, there's a lot of risk associated with that. And usually it's because they're dealing with that traditional basis. Your traditional basis will be what your cash market is minus what the futures market is, and that equals your traditional basis. Your quote unquote LRP basis is the cash price received minus the cash price index that you are indemnifying against. So it is essentially the cash price for that commodity that you're covering minus the price that you lock in for your LRP policy. And traditionally, that's a much smaller than a traditional basis. So that gap, it being smaller, that usually means less risk, and your lenders like less risk. If you have a producer that is interested in taking out an LRP policy, they must first have an approved application on file to take out that LRP policy. Usually that application is just basic contact information and tax IDs. It does not commit that producer to anything financially. They can have an application on file and then never take out an endorsement. An endorsement is what actually sets your coverage or your protection for a particular group of animals. And usually, depending upon what AIP your agent works with, I know the ones that I work with, I can usually get approval within 24 hours. Sometimes it's quicker than that, assuming that there's no hiccups and all tax IDs pass clearance and pass RMA. All RMA looks at is that basically that you are who you say you are, and that you're not on any sort of insurance blacklist for not paying your premium. And then also the only other requirement is that if a person was to take out coverage, you technically need to own the livestock that you are insuring, and you must own them at the time of coverage. So your LRP sales. Sales are open daily, or at least Monday through Friday. So every day that around 2:30 Central Time, the RMA will put out their expected prices for all the various classes of livestock. And we have from when, if you're set up like on an automated quoting system, you'll have from when you get those quotes until 8:25 the next day to fill out the appropriate paperwork and cover a particular group of livestock. You can cover for Friday sales, we do have till Saturday to lock those in. Sunday, there will be no sales numbers put out. And then we'd have to wait till Monday afternoon if you're wanting to cover something after the weekend. Also, there won't be any sales available on federal holidays. Like just last Friday when the USDA put out their cattle on feed report, there was no cattle LRP sales available that day. And also, if for some reason by 4:30 p.m. Central Time, if RMA does not have a sales effective date listed on their website, then no sales will be available or offers will be available that day. Sometimes it's just because they don't feel since I've been doing it, I've not seen this happen. I could see it happening if there was ever some sort of black swan event that caused severe market disruptions, or some sort of market crash, or if they just didn't feel like they had enough sales data to establish proper pricing. And people also don't realize that there is that very short window to lock in things. So if you have any producers that are interested in it, don't let them hesitate to reach out to their agent. Doesn't matter how late or early. Once that market opens for the day, or the Chicago Board of Trade opens for the day, you can't lock in anything. So that's why they are on such a tight turnaround. So your specialized coverage endorsements, you can lock in anywhere from 13 to 52 weeks in advance from any one sales effective date. Not every time period is guaranteed to be available daily. So how this hasn't happened very often, but I know like last fall, when, we were on that huge run and we were seeing, unprecedented prices, the way the approved insurance providers manage their risk is that they have a certain quota that they're willing to fill on a daily basis. So for example, last fall, there was, believe it was like the 21 and 26 week time periods weren't available for a few days. But that was just because they had hit their sales quota. That's how they managed their risk. So it wasn't available. If you just wait a few days, a lot of times those come back. So it's not guaranteed to be available daily, but there's been very few times in my time of working with the LRP program that not every endorsement length has been offered. This change for 2025. So the LRP crop year runs from July 1st to June 30th. I don't know why that is, but that's the insurance year for LRP. It used to be specifically for the cattle, you could only lock in anywhere from roughly 90% up to 99.9% of that expected value. For the 2025 crop year and after, they've actually widened that range of coverage levels that you can choose from. And you can lock in anywhere from 75% all the way up to 100% of that expected coverage price. I have yet to meet anyone who the maximum number of head on an endorsement has come into factor with. But any one day, one person or entity can insure up to 12,000 head on any one endorsement, 75,000 for swine. In a year's period, it would be 25,000 head of cattle and 750,000 head of swine. And there is no minimums to be insured. If a producer wants to cover one head, he has every right to do that. And I have done that on multiple occasions. Some of those really small producers, some of them have just covered only one head. And the one thing that's different with LRP when maybe compared to crop insurance, if you guys are familiar with that, in crop insurance, you have to cover your entire commodity within the county. With LRP, you don't have to cover your entire group. So if you have a group of 100 feeder steers, you do not have to cover that entire group. You can if you want, but you by no means have to. And you can also layer that protection to kind of spread out your risk. So if you were really happy with the markets, but you still thought that they could get better, but wanted to protect yourself in case they didn't, you're more than within your right to cover just a percentage of those cattle. So on one day, you might cover 25. A couple days later, the markets go up, you can cover the next 25. And then if the markets stay the same or they start to trend down, then you might choose to lock in the rest. Or you may not have part of that group covered. That's, again, speaks to the flexibility of this product.
Lindsey, I wanted to point out the one reason we're doing this in June or July was because that shortest time period was at 13 weeks. So you're looking at roughly 3 months.
Yep. So you're looking at October, November would be the shortest time period you could lock in.
Right. And so that's why we're looking at doing this now. So.
Yep. And I would say too, once you get comfortable or your producers get comfortable with the LRP product, I know when I started working with Richard, he, locked in a few groups just to try it, get a feel for how it works. But once you get comfortable with the program, I really highly recommend your best value is usually always when you can look at the long view. When you lock in animals and you can lock in that, 30 to 42 weeks, usually you can capitalize on a little higher prices with the futures and it's your better value. But you by no means have to, but a lot of times it is a better deal. So these next couple slides, we're going to go into the specific commodities a little more in depth, just to kind of show you the little differences and nuances between the feeder cattle, fed cattle, and swine. Your feeder cattle, there are actually 11 different classes that those cattle can be classified into. For your conventional beef cattle or colored cattle, they need to be separated by steers versus heifers. There's a predominantly Brahman, a predominantly dairy. For those two, if you've got, beef on dairy or F1 crosses, they would fall into the traditional beef cattle, just the regular steers and heifers. It's when you have the purebred Brahman and dairy that they would fall under those classes. And they take significant price discounts. Just a note on those. And then for any cow-calf guys, they can also capitalize on an unborn steer and heifer policy. Within each of those broader categories, the steer, for example, the steers versus heifers, you will have a light class of steers and a heavy class of steers. And the same with the heifers, the predominantly Brahman and the predominantly dairy. So your light steers and heifers would be anywhere from 599 pounds and below. And then your heavies would be 600 to 1,000 pounds. And this is on a live weight basis. The pricing for your feeder cattle is based off the CME Feeder Cattle Index. So for any of you that like to follow those markets pretty close, if you were to go to the CME Feeder Cattle website or CME website, looked up their feeder cattle index, the pricing that they have for feeder cattle is what you're going to see is the expected price for your heavy steers. So those 600 to 1,000 pound steers are what is kind of your baseline or what everything is centered around. Then your light steers are actually at a 10% premium of what that CME Feeder Cattle Index is. Your heavy heifers are going to be at a 5% discount from those heavy steers. And then your light heifers are actually going to be the same price as what your heavy steers are. Then your Brahman and dairy cattle, they're actually at a 50% discount. So to be completely frank with you, yeah, I would have a hard time covering those Brahman and dairy cattle. It would really just depend on the price per head, because you really can't capitalize on those prices that you can with your traditional beef cattle. With your feeder cattle, the cattle do not have to be sold by the end of the insurance period to receive an indemnity. So an indemnity is if you were to have a loss or a claim. So the two prices that matter with any LRP policy, the only two prices that matter is the price on the very first day of your policy. So the price that you lock in on the very first day, and then the price that RMA publishes on the last day of your policy. So if we were to take out a policy today, I believe we're, towards the end of October would be the 13-week period that we could lock in. Let's just say it is October 23rd. And the only price that matters was the future price today that we locked in, and what the cash price was for that commodity on October 23rd, or whatever your end date is. You can sell those cattle before your end date. You just can't sell them more than 60 days before the end of the insurance period. That's to basically keep those speculators from taking advantage of and abusing the system, so to say. For the stockers, if October 23rd comes around, you've decided to retain those calves to feed them out, or you've decided to keep some of those heifers as replacements, that is totally fine. If you are due an indemnity or have a loss, we just have to turn in proof of ownership. So if you sold those animals ahead of time, that's totally fine. You turn in your sales receipts. That's all the insurance company wants. If you still have those animals on hand, we just need to have an unbiased third party prove ownership. And there's also lots of flexibility with that. It can be your veterinarian, a feed rep, an extension agent. There's lots of different folks that I've used as proof of ownership. For your fed cattle, there is not the same number of classes like we have with our feeder cattle. It doesn't matter if they're steers versus heifers, if they're dairy steers, eared cattle, they all fall under one class. And all the target weights, like with the feeder cattle, are based on a live weight basis. And your target weight can be anywhere from 1,000 pounds to 1,600 pounds. The pricing for your fed cattle is based on the live FOB for cattle that are grading greater than 80% choice. If you look at, and these numbers are pulled from your 5 area weighted weekly average. So if you're looking at those USDA reports, that 5 area weighted weekly average is where they're pulling those prices. What is new for 2025? Like we mentioned on the last slide with feeder cattle, if you have a loss and you have fed cattle covered, you have to have those cattle sold within a 120-day window. So there's the 60 days before the end of your insurance period and the 60 days after the end of the insurance period. Before, again, if you still had those cattle on hand, all you had to do was provide, unbiased third-party verification. But at this point, you actually have to show that those cattle were marketed. I know when I attended some of the STIPA meetings this spring, that was a change that a lot of agents didn't like. However, I actually thought it made sense. If you're going to use LRP properly and how it should be used, you have some flexibility. You have a tentative idea of when you would like to market those animals, but depending upon efficiency, gain, what the markets are doing, you might hold on to them a little longer. You might move them before. But if you're running an efficient and profitable operation, you're not going to keep those fed cattle more than 60 days after that target date anyway. That's just my personal opinion. And I think it's very doable. As far as swine, there's 2 different classes that you can choose from. I don't know how many large swine operators you guys have in your area. I didn't mention it earlier, but I come from a cow-calf background, so beef cattle are what I'm most comfortable with. I do deal with some swine customers. To be totally honest, not a lot of them like to take advantage of the LRP, or it's been a lot harder sell with those swine producers. Like the feeder cattle, they can take out an unborn swine policy. Like with the unborn cattle policy, when you take out those unborn LRPs, you have to provide either for the cattle proof of pregnancy, whether that be a vet record or a vet verifying you preg checked X number of cows and they were confirmed bred at the time, or you have to be with swine, you have to be able to prove what your average litter size, and they'll just take what your average litter size and then multiply that by the number of sows you're wanting to cover. The no type specified would just be kind of like your feeder finish scenarios. What is different with swine is that those target weights are based on a lean weight basis, not a live weight basis. So that lean weight basis is assuming 74% dressing percentage essentially. So most of those should fall between 140 to 260 pounds, or 1.4 to 260, sorry, lean weight basis, which would be approximately 189 to 351 pounds on a live weight basis. So a pretty wide weight range there. And that pricing is based on the CME lean hog futures. Before we get into kind of some specifics of locking in, does anybody have any questions as far as just general LRP so far?
And if anybody does, you guys can type them in chat, or we'll catch them.
Yeah.
If somebody does. We can go on if they do have questions. So.
Okay, perfect. So this is kind of an example of a quote that a producer could receive as far as the different when sales offerings are published for the day. So as you can see in this is just a small snippet of the information that's available as far as sales prices that a producer can choose from. This is technically just showing one of those time intervals, which would be your 13 weeks. Actually, I ran this today. So 13 weeks from today would be October 21st. This particular example was for fed cattle. The insured has 100% interest in those animals, and their target weight is 1,400 pounds. So in just this one time period, so just in the 13 weeks, and this would be multiplied by every other time interval that you have to choose from, you can choose all the way down from 75% of that 185.10 up to 100% of that 185.10. So this is yesterday's numbers. So if a producer wanted to lock in 100%, they would set their floor for their 1,400 pound steer at 185.10 per hundredweight. So your total liability or value of the animal that you're covering would be just shy of $2,600. And that would cost them about $62 a head. So as you can see here, there is a very wide range in terms of premium per head. And, everyone always likes to ask me, what is that sweet spot, so to say? Where is the best bang for your buck? And I honestly, it's, I know it feels like a cop out, but it's not really a fair question because each operation is very different. That producer knows their expenses better than anyone. And, you know, depending upon what your other input costs are and where you want to keep your production cost per head changes greatly from operation to operation. You know, I've got a lot of guys that will always do the lowest coverage level, which used to be around that 90%. Now they can go even lower. I don't feel like it makes much sense to go especially much lower than 90%. Because I think it just makes sense to keep your trigger as high as possible. I can't tell you how many guys over the last 6 to 9 months, when they locked in, you know, what we thought were really high prices at the time, but when they select, you know, for example, here, let's just say 9 months ago, they locked in 185, but they went right in the middle. They went at 95%, which was there at 175. And when their policy expired, the cash price came, you know, at 180. They didn't have a loss because they selected a lower coverage level. Whereas if they would have had the highest coverage, they would have more than paid for their premium. So it's really just producer dependent what your operation is like. There's no right or wrong answer. But me personally, I think it makes the most sense if you can afford it to keep your trigger as high as possible. So that's kind of the quick and dirty of it. If anyone has any specific questions, I would love to answer those. If you want to hear a little more about, I know this call was about LRP, but I think PRF is a nice complement to the LRP product that just kind of spreads out your risk and covers all aspects of your operation. But I'd love to visit with you guys and have some back and forth about it.
Does anyone have any questions for Lindsey? And Lindsey, that's actually our topic next month on our Ag Talk Tuesday.
Oh, great. Good.
Somebody else is going to cover the PRF.
And so, good. Awesome. I'm glad. Well, that's great. And I'll let them cover that then. But that's a wonderful product that works great with LRP.
I know, Lindsey, this is for me, the confusing thing for a lot of the farmers I've worked with is how the LRP actually works. Is, you know, they're not insuring their cattle, they're insuring that price. You know, they think, right. Oh, hey, if I sell my cattle cheaper than that, no, it doesn't have anything to do with what you sell your cattle for. It's the price on that 12 area market price. So.
Right. And that is the hardest thing for a lot of producers to understand, is that it doesn't matter what you physically sell your cattle for. It's all based on the numbers that RMA puts out on the first and last day of your policy. And some folks don't like that because they're like, well, it's just a numbers game. And I was like, yes, you are not wrong. Theoretically, yes, it is a numbers game. But you know, in our neck of the woods, I'm here in Southern Ohio. The average herd size in Ohio is, I think, around 17 to 20 head. You know, not very many producers around here can put together a full pot load of feeders or even fed cattle. And so since they can't put together those large groups, they can't capitalize on higher prices. Whereas out west, where in the markets that these numbers are based off those producers who can put together lot loads. So, you know, here east of the Mississippi with these smaller producers, they can capitalize and take advantage of higher floors than what we're historically used to. And because a lot of times, especially here in my neck of the woods, you know, my hometown's a little unique in the fact that we're the only town east of the Mississippi with 2 stockyards within the city limits. So Our prices are generally competitive because there's so much competition between the barns, but given where we are, it's still not the same as what you would see, you know, in Nebraska, Kansas, Texas. So in that case, us folks in our neck of the woods, you know, Ohio, Kentucky, Tennessee, we would almost always have a loss.
Yeah.
So this is also a way for RMA to level the playing field, so to say, and get rid of that market bias. So we can capitalize on better pricing and have a higher floor on those animals, but yet it makes it fair across the board for all producers to get the same benefit from these kinds of products.
Okay. And Lindsey, I do have one question. You can go back to the slide where you had the sheet up there you looked at this week. And so the top coverage is $62 a head. So what price level, if say the market happened to be $1.80, like you had mentioned, what would that producer get paid? It cost him $62. What's he looking to get paid on that animal?
Yeah. So how that works is that you get paid the difference. So you would get paid the difference in price times what your target weight is. And then that's how it establishes what your indemnity is.
So in that case, it'd be $5. It'd be $5.10 times the 14.
Yeah, so that would be essentially $70 a head.
Okay. All right. So in that case, if it
so you'd clear $8 over what your premium was.
Yeah. And then, you know, a lot of our guys are going to be doing with feeder cattle. I'm assuming if you pick the class 1, you're looking at 599 pounds on that end, or if it was class 2, you know, is what 7 to 8 weights is what they would base that at, or
yeah. And actually, and not to change the subject, but another thing I didn't mention is that you also have some flexibility with your target weight. So regardless of what class it is, your target weight is what establishes your target weight, target end date, and coverage level are the 3 factors that go into your premium calculation. Okay. So for example, in this example with the fed cattle, you're paying the $62 is based on a 1,400 pound animal. So you sell those animals, let's just say you only average 1,300 pounds. That's fine. If you have a loss, you're still going to get paid based on a 1,400 pound animal. But it's also difference if they come in and they're at 1,500, you're only going to get paid up to 1,400 because that's what your premium you paid was. So for the feeder cattle, it's the same general concept. The only time that your average weight matters is if it puts you into a different class. Yeah. So if you locked in, let's say you wanted to lock in 650 pound calves and your calves came in at 575. You won't get, because those light steers are at a premium, you're not going to get the pricing for those lighter calves. So you potentially could have a indemnity adjustment just because you're guaranteed a minimum of X number of pounds and it puts you into a different weight class. So that's the only time that it really matters. So I try to tell folks that, you know, if you're really close to that breaking point between classes, I would consider maybe going towards the lighter class because sometimes you can capitalize on a higher value. And even though it's a nickel lower weight, you're ensuring more value per animal, if that makes sense.
Okay. Yeah. That's the only thing I didn't hear you mention was, okay, we've seen the premium price, we've seen the coverage level. How did we determine what we got paid for?
Yep. It's all based on your target weight that you locked in, but you still have to, like, if you had a loss, you still have to prove ownership, the number of head that you locked in, and just show an average weight. They're not super picky about it. again, like I said, unless it puts you into a different weight class. But if you had extenuating circumstances like severe drought, and you can prove that, and that's, lack of feed or poor quality feed, sometimes they will accept that as a reasonable excuse why they were too light, and they will pay you the full amount that you're owed.
All right. Anyone else have any questions? Anybody else on our group? If no one has any questions, I want to thank Miss Lindsey for her time. If you have questions, reach out to one of your agents, and we'll get you in touch with Miss Lindsey. I know Richard Brown says you do a lot of work through UPI, United Producers, uses Lindsey, and so she's out of Ohio, but I know they United Producers here in Tennessee and Kentucky, and they use Lindsey as well. So thank you, Lindsey, for being on and speaking with us tonight. Is just like she mentioned, the PRF insurance. We're going to have Mr. Mike Tanzel next time. He's going to be speaking to us about the PRF program and how it can benefit producers as well. That'll be about a month from tonight. I think it's going to end up being the 16th or 17th of August. It's the third Tuesday in August that we'll have him on speaking. So, but with that being said, I'm going to end the recording. Thank everybody for coming out. We'll see you guys next month.
Thank you so much. Thanks, guys.